Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in today's video, we'll be taking a look at IPO based breakouts. So this is just a method of trading the IPOs. What are IPOs? They are just the newly listed companies, and it's relatively very easy to trade uh, the IPOs, and you can get a very good move in very short time. You can get really good returns. So in this video, we'll be learning how to catch them before they give that big move. So what are IPOs? So IPOs are just the process of offering shares of a private corporation to the public in a new stock issuance for the first time. So let me simplify it. So suppose there's a private company and uh, it is owned by a single person or a group of persons. But now they want to make it public, like they want the company's stock to be listed on the stock exchanges like the National Stock Exchange or the Bombay Stock Exchange. It could be for variety of reasons, to raise money, or if to give a big fund exit who have invested in them from earlier time. So what the company would do, suppose the promoter holds the 100% shares of the company, and what the company would do is it just offers its ownership, let's say 20-30% ownership, to the common people like you and me. We can just go to the stock exchange and now buy the shares of this company and take a stake in the company. So that is basically the process, and this is what IPO is: initial public offering. Any private listed company, whenever it goes to the public markets to raise money, or mainly to raise money, and issues the stock to the people who operate in the stock market. So what are IPO based breakouts? So let's say this is the listing day. So this is a stock ethos. They are a luxury watch manufacturer. So there's a listing day. Whenever a new stock is listed, the day it is listed, the day it start trading on the stock exchanges is called the listing day. And so this is the listing day candle, as you can see. So what I identified is that whenever you buy a stock above its listing day high, it gives a really good move. So why it makes sense to buy above the listing day high? Let me explain that. So this is our listing day candle, as you can see here. This one is our listing day candle, and after that the stock started going down. So why is that? Why the stock may go down? Because uh, a stock, whenever an IPO comes, it is offered at a certain price. Let's suppose the stock was offered at 600 rupees. So people who invested in the IPO, they got their shares at 600 rupees, and then there's the listing day. And suppose in this case the stock listed at around 800 rupees to 820. So what happens that many people who bought the stock at 600 during the initial public offering, they will start selling to book gains, and after that selling pressure comes in and the stock starts going down. So that is what happens. So that's why sometimes the stock may go down, or sometimes it may not even go down. So why does it make sense to buy it above this level? Because let's say the stock was listed on this day and started going down, and as you can see in this case, after that it again came up, but again it was facing resistance at this level. It failed to cross this listing day high and just consolidated in a range. So what is happening? People who bought at 600 during the initial public offering are now selling, and people who didn't buy it at that time, they like the company and they want to get in. Uh, so demand is provided from those people who are currently buying the stock, and that's why, as you can see, it's just consolidating. And when the supply gets over, right, whenever the supply gets over, as happened here, let me remove all the markings. As you can see here, the breakout, whenever the supply gets over, it crossed this day, it crossed the listing day high, and look how beautifully it went up after that. So once the all the supply is over, the people who bought it during the IPO, during the initial public offering, have sold their shares. the new set of buyers have come in and they are taking the price higher because they still think the company is still undervalued, or maybe there could be variety of reasons. So once the supply is over, there is a clear ground, there is no further supply because the listing day high, because the listing day high was the highest point at which the stock currently was, and the point where the supply was present. So once that area is cleared, once that supply is over, the stock is free to go up, as happened in this case. You can see how beautifully it went up from around 800 rupees to around 1020, and after that again consolidated for a bit and again a breakout, and now just pulling back. Let me show you another example. This is another example of an IPO, Rainbow Children Hospitals. And so this is the listing day candle. As you can see, the price opened at around 500 rupees and closed at around 460 something rupees, 40 rupees down. So as you can see, the people who bought at the initial public offering, I don't exactly remember the price, what was the price of the IPO, but let's suppose it was 400. So people who bought at during the IPO are now selling, booking the profits. That's why the stock came down, and after that you can see it came down to around 420 and 410 rupees, and again it started going up again. The supply was present there. As you can see here, the listing day candle high, the supply was still there because some people were still left who haven't sold their shares, and again the due to the supply again started coming down. But as you can see here, people thought that around 400 rupees, it has some value. That's why again the price again started taking support at this level. You see, first time it bounced back from this level, again went up to around 500 rupees, again came down, again went again started taking some support at this level. That means the supply, the demand, you know, that means simply that the demand is present around this area. The same thing that happens in normal stocks as demand and supply, or support and resistance, simply that rule. And again, if you see again this region of 500 rupees, again the stock faced some resistance and the supply was still there. And once the supply was over, look at how beautifully it crossed that area and went up from around 500 rupees to around 620 right now. And again a small pullback, and after that consolidated a bit and again a breakout. Here again another example of Hari Om Pipe Industries. So here the case is a bit different. So this was the listing day high candle, and next day the stock closed above that level. So the supply was not there, but again after that the supply came and the stock went down again, and after that it formed a long 4 month long base. And once this area was crossed, look at the size of the candle. Once the whole supply was absorbed in this area of around 227 rupees, once the whole supply was absorbed, look how beautifully the stock went up. The stock went up from 227 to around it made a high of around 285 something level. So once the supply of this around this area was over, the stock just uh, went up like crazy. So this is the typical way to trade IPOs. Just whenever the stock crosses its listing day high, the it's like the sky is clear. The stock can go as high as the demand takes it, right? Once the supply, because there is no supply from before that, because the stock is newly listed. So whatever the supply is of that time, the newly whenever the stock was newly listed, so supply is from only that time. And once it forms a base, all the supply is absorbed by the buyers, and it just crosses and it gives a really nice move. So as you can see here, another example of Campus Activewear. This was the listing day candle. Again the stock faced some pressure and came down, and again faced started forming base, and then after that around this level of the listing day candles level, it formed a base, gave a breakout, went up from around 380 rupees to around 460, formed a second base, again a pullback, small pullback, again consolidated, gave a breakout and went up to 520, and now it's forming a third base. Again it can give a breakout. So once this our first base area, that was around the listing day high candle. Uh, so once that was cleared, the stock just resumed its normal movement once the your beginning supply is over, and after that the stock can easily go up. Here I have another example of Vedant Fashion, and here This was the listing day candle. The stock went down. It fell from around something 1,000 rupees something to around 800, and again came up once the supply was absorbed, crossed this level, and again consolidated, formed a very large base, as you can see here. Classic VCP, that is the volatility contraction pattern characteristics. As the stock moved from left to right side, contraction getting started getting smaller, as you can see here. A large cup, a smaller, and then a smaller, and then again a breakout after a something like 5-6 month long base, again a breakout, and now just consolidating again. So that was it for today's video. Just it's a simple way to trade the IPOs. Whenever the IPO crosses their listing day high, you can just buy them. That is the most optimal time, I would say. That is the best time to buy the IPOs once they crosses their listing day high, because there is no further overhead supply. So once if there is no further overhead supply and there is enough demand, the stock will keep on going higher. And whenever the stock comes back, a pullback and all, that is just a normal reaction. The people who bought early are just now selling, because not everybody holds for long term and something like that. So people just buy it for the short term. When the stock goes up 50 to, let's say, 10-15%, some people will sell, and then the supply will be created, and again if there is enough demand, that area will also cross and the stock will resume its journey. So the best time to buy an IPO is when it crosses the listing day high, and especially if it crosses that level with a gap, that indicates that the supply is the demand is very very strong. If it crosses that the listing day high region, if it crosses with the gap, that means the demand is really strong, and that is your typical buy point. So that was it for today's video, and this is not a recommendation. I'm not a SEBI registered analyst. Please consider taking advice from your uh, financial advisor. That was it for today's video. Thank you very much for watching. Don't forget to like, subscribe, and share. Goodbye, take care.